Today's show is brought to you by the Third National Bank. After 2 tries, we think we've got it right. Welcome to The Grasp. I'm Doug. We begin the series, The 5 Easy Steps to Getting into Crypto, with the first point, which is risk assessment. I think this will be informative and enlightening, so break out your pencils and let's get to it. Life is full of risks. They can't be separated. Life involves risk. But we weigh those risks every day. Let me just give a few examples to illustrate my point. It is a fact that every single day in every country around the world, people die in car wrecks. That's a fact. People die from driving cars every day. And yet, most people, knowing that information, weigh the risk and think the probability is really low that I will die in a car wreck today, so they hop in their car and they go to the store or to work. Happens every day.
Dong! Where is my automobile?
Automobile? Leg. Big leg.
Another example, this channel intentionally stays away from topics of politics.
It's all politics, but he's a rebel.
But COVID, over the last couple of years, has been a real issue, and it's something that everybody's familiar with. Now, same as the car, there are risks involved. And when COVID first rolled through, the response of the government was, hey, let's just shut everything down because the risk of COVID in their mind outweighs any risk associated with shutting down the economy. Now, as time has gone on and we've gotten more information, more people are willing to weigh that risk and say, you know what, I think that the probability of me getting COVID or getting COVID in a serious manner is slim compared to me going and living my life. And you see more and more people choosing to go out and try to live a normal life in the spite of the COVID pandemic. So clearly, they are weighing those risks. The last example, something dear to my heart, I love motorcycles. I have the coolest motorcycle on the planet, and riding motorcycles gives me such joy and a sense of freedom. And so I love to ride. Now, obviously, there are risks involved because people die riding motorcycles as well. And a lot of people would say, oh, that's too much of a risk. I would never take that. And that is a choice that they can make. I wear all of my gear all the time, so I always have my safety gear on. I'm a very cautious rider, and I don't trust other drivers, so I'm very defensive in the way that I ride. And in my mind, that is a risk worth taking. I weigh the positives, the joy, and the freedom against the risk, and I make a decision on that.
Heavy metal.
So when we're talking about financial assets, there are several different types of risk that need to be considered. Now, if you've watched some of our other videos, especially our inflation videos, you know that whether or not it is conscious in the minds of everybody, inflationary risk is very real. So to have your money sitting in a bank is not the best choice because inflationary risk is very real, and we have seen that over time it has averaged about 10%, and over the last couple of years because of COVID, it's closer to 30%. So that is a very real inflationary risk.
I don't think there's anything to worry about.
Obviously, there's also monetary risk. There are other types of risk involved, but what most people think about when we're talking about investments is volatility risk. The risk of a movement against you where you lose money.
Can't imagine why I would.
Volatility risk is something that can be looked at and managed, like any other risk, like riding my motorcycle or driving your car. So there are really 3 questions, 3 areas that we want to look at when we're assessing our risk. Okay, so the first one is your ability to take on risk. And that comes down to two primary factors: the time frame and the stability of your income. So let's start with the first one, time. Now, time risk can be looked at in a couple of different ways. First of all, what is the goal of this investment? Are you investing for retirement? Because that's one type of goal. Are you investing to have some income? That's a different type of goal. Are you investing because you're hoping to trade and take advantage of a movement just to have some spending money, right? So you can see those are three different types of situations. And so time factor applies differently depending on what those situations are. So let's just start with retirement, because that's something that most people can easily get their head around. So if you're young and retirement is a long way off, you can afford to take on more risks because you have a longer amount of time to take advantage of the macro moves of the market. You understand that all markets, cryptocurrency, stocks, bonds, futures, options, all markets fluctuate, right? You'll have runs up and you'll have a run down. You almost think of it like the waves of the ocean, because that's how markets move. And so if you have a long period of time, you don't have to worry so much about the small moves in the markets, because over time you believe they're going to continue to go up. If your time frame is short, that may be different, because if you happen to get in at the wrong time and you're only going to leave this for a few months or a year or so, you could possibly run into a bear market where prices slide significantly and you lose money. So those are factors that need to be considered in your own personal situation. What time frame are you looking at for this particular investment?
I'm waiting!
The second piece is income stability. Now, if you have a steady job, income consistently coming in, you're on a salary, then that's one situation, versus if you're a gig worker or if you have a shift type work or part-time type work that isn't necessarily constant and steady and you don't know necessarily where the next paycheck's going to come from. That's a completely different situation. So both of those, the time and the stability of the income, factor into any risk assessment. Now, if you're talking about pulling income out or you're talking about trading, then I can do a whole series on that, because that is a really in-depth topic. And I probably have hundreds of hours of training I can do on how to approach the markets in those ways. But that's a completely different thing. If that's something that you're interested in, please comment down below and we'll see about putting something like that together.
Well, very nice presentation.
The second part of risk analysis is your willingness to take on risk. And this is a personal thing, and it's very different from person to person, because there are some people who are extremely risk averse. I don't want to see any pullbacks in my income, right? As you look at your statements or whatever, just the slightest little pullback drives them crazy. That's one type of personality. You have other people who are willing to take on risk. So the amount of comfort that you have in tolerating pullbacks will also determine the type of risk that you're willing to take or should take. So if you are more willing to sit through risk, then you can take on more aggressive, more volatile types of instruments, which of course generally yield much higher gains. If you're somebody who cannot tolerate a loss, then you should be steered more toward something that's stable. The third piece is your need to take on risk. So if you are young and you have a goal of, say, have $1 million or $2 million by the time you're 50 years old, then that is one risk profile. You'll have to take on more risk in order to generate returns that provide the yield that you need in that time frame. However, if you're 50 or 60 and you're close to retirement and you just want to preserve capital, that's a completely different risk profile, in which case you don't need to be into very risky or volatile assets because you're just concerned about preserving the capital that you have.
Could you wrap it up? We're waiting on you.
So, to review in a nutshell, when we're talking about risk, there are a few questions you need to ask yourself. And that is, of course, how comfortable am I with volatility? What is my need to take on the risk? What time frame am I looking at? All of those things are going to determine where you should be putting your focus on your investment.
And your problem is you.
I will make one further comment, and this is about inflation again. Again, if you haven't watched our inflation videos, please go and look at those. But inflation risk is real. It exists, and it's just a fact. And so a lot of people don't put that calculation into their assessment when they're looking at things because they don't even think about inflation. But for instance, our 20-year-old, if our 20-year-old wanting $1 million by the time he's 50, well, with inflation eating on average 10% a year, 30% in recent years, then that $1 million at 50 is going to be easier to attain because it's not going to be worth nearly as much as he thinks it's going to be worth in the time he's 50. So that's something that needs to be seriously considered by everybody. Inflation risk is real, and so we have to be looking at things that are going to do better than that. On par, as I've stated in my inflation videos, the stock market has generally kept pace or outperformed inflation a little bit. So if you have $1 million today and you need $1 million buying power 20 or 30 years from now, you have to do better than inflation. But that's just keeping pace. If you have 100,000 or 200,000 or 50,000 and you want to have $1 million in 20 or 30 years, then you have to do much better than inflation in order to still have that buying power at the end. So that wraps up our first step video, assessing risk. Next, we'll get started into how to set up a brokerage account. So we'll see you back here on The Grasp.